One, you guys are live.
All right, it's March 30th. Welcome to Wall Street Beats. We have Charlie Peabody and Bob Morris coming at us when I'm Benjamin Bry. It is amazingly the end of the quarter tomorrow, boys. It's been quite a quarter, huh?
It has started off well and it's been ended horribly.
We started out the year with everybody and their brother being bullish on the market, and here we are.
Well, I talked about that where we had in like the second week, the IWM was annualizing like 100% or something. I was like, this has to be the sell sign. I mean, you don't need any more information. And it got a little choppier. That's how 22 kind of had a similar feel where it wasn't gangbusters off the shoot, but it was okay for the first 2 weeks. And then that war just crept in, and then 22 was an ugly year. So I guess let's lead it off like that.
Yeah, I just want to remind you that I said that Bob was going to be the king that we all wanted to follow. And
Bob deserved his moment in the sun, though. The first 2 years of Wall Street Beats, oil there was nothing done. It was just, hey, it's steady. I'm selling my calls. I'm taking my dividends. And Bob was very steady. He didn't chase anything. He was just stuck with his process. But now he's the man. That's right.
Yeah.
Now
Bob,
go ahead.
Go ahead.
No, go ahead.
I was going to say, last night we were reviewing the March returns, and I called March a crime scene with no survivors, except, and that was the title, but it was like, except for energy. And, as we go forward, how you feeling here? Let's lay out the scenarios you see, not necessarily what you think's going to happen, but like kind of the scenarios that can happen over the next 30 days to 60 days, basically. Because I think there's one thing that there is a cliff out there, I think, that's looming that I don't think is fully appreciated by the average guy. Experts probably know, but let's talk about that a little bit.
Sure. So, and the one thing that's interesting is while oil's up on the spot basis, up $3 this morning, the curve out in December, January, and the spot price continues, or the futures price continues to be around $75, $76 a barrel. So the market's been pretty steady in forecasting that eventually things settle down to the point where oil is going to be around $75 a barrel at the end of this year, 12 months out. And in the meantime, the front end of the curve or the spot price is moving around based on the latest headlines or threats or what's going on. And that fear or concern is out there. And so we talked about last week that oil's not going back to 60. I don't think it's going back to 70, maybe not 75. I think the new normal probably is somewhere where the 12-month strip is reflecting at around $75 a barrel. Now, there are a lot of scenarios that could play out here because here we are on Monday and nothing happened over the weekend. Trump originally set a deadline last Friday to blow things up if there was no deal. He extended that deadline by 10 days. And so now it's sort of interesting in that he said that, there's a new and more reasonable regime in place that we're negotiating with. Well, who is that? We don't know. There's no visibility. And is it really a new regime? Because the whole intent here from the beginning was to have regime change. But with everything that's going on there and missiles still flying and not knowing who's in charge, is this really a, quote, new regime? Or is it just part of a fraction of the old regime that's appearing to be more reasonable? Because remember, the way Iran's negotiated for the last 20 plus years is the stall. Say, yeah, we'll do this. We'll sort of give on this. And in the meantime, hope behind the scenes that we're continuing with their objective of enriching uranium and eventually making a nuclear bomb. So now, is this truly somebody that's going to toe the line and really provide the visibility that they're not enriching uranium, that they're not developing a nuclear weapon? We don't know. And, remember it was over a week ago that Trump said, well, they gave us a really good present. Well, we really don't know yet what that present was. Now, today, apparently, they're going to allow 20 oil cargoes to go through the Strait of Hormuz. We'll see how that goes. But in the meantime, Trump's saying, look, if we don't have a deal soon, we're going in and blowing up everything, basically. We could blow up their oil wells. We could blow up Carg Island. We could blow up their power generation facilities and even maybe their desalination facilities. So if it comes to the point where there's no deal, and I think reaching a deal that's going to be acceptable to the U.S. and its allies, is going to be really difficult because there's a very hard red line there. If they go in and blow up their oil wells, that is not easily repaired. That's not easily replaceable. And so then you've got more than 2 million barrels a day of oil that you're not getting back anytime soon. And that just raises the floor on what the oil price is going to be going forward from here. So I think, the best case scenario is this afternoon they come out and say, we've got a deal. There's a new regime. This is who they are. Somehow Iran opens up and says, yeah, we have new leaders. This is who they are. We're totally changing the face of the country and the leadership, and we're going to play ball. We're going to let you fly in, take out all the uranium that we enriched, and it's over here, and you can find it and take it. We're not going to develop a nuclear weapon. We're going to provide clear visibility on anything you want to look at. We're going to let a coalition of Gulf or Middle East countries join together to manage the Strait of Hormuz. And I mean, that's sort of the pie in the sky scenario, the upside scenario. And you say, okay, everything's good. Oil's going to flow. Maybe oil pulls back to $75 a barrel because there's always going to be some now risk premium for the fear that things break down at some point. So I think the best case scenario, and I think this is not likely, but this is really, less than 5% chance that immediately peace breaks out. Everybody's happy. Oil flows, straits open. Everything seems hunky-dory and it's going to stick. And you're at $75 a barrel. Worst case scenario is, and, it's probably more likely in the worst case scenario than the absolutely best case scenario, that the talks break down, that no deal is reached. And, in the next week to 10 days, the U.S., Israel, and whoever else starts bombing their critical facilities, whether it's, in addition to the power generation, the oil wells, Carg Island, all that sort of stuff. And there's no resolution. There's no easing of oil flow. And the tensions just continue to escalate or percolate there. And things, get out of hand from there. Remember, this is a very ideological regime, extremely ideological regime. And it's going to be very, very hard to get them let go of their objective of, basically wanting to, among many things, go after Israel. And you have to have a really, really change of mindset from this ideology, which is going to be really tough in a country of over 90 million people. They've got these proxy alliances with the Houthis, Hamas, to get everybody to lay down their weapons and say, okay, yeah, we're going to play along here. I think it's be extremely, extremely difficult.
Right.
So the worst case scenario is we roll along here with oil continuing to be $95 to $100 per barrel plus.
Yeah, and I guess what I'm asking is more like, what is it going to take to get like a scenario? Well, first of all, the price of oil is one thing, but what really people care about is the price of the refined products, right? So jet fuel is up 100%. Gasoline is, up in the markets where, in the U.S. it's not as big a deal, but in some of these other markets, they're starting to have, I saw in France, there's 300 gas stations that have no diesel right now. My podcast co-host Rupert lives in Melbourne. I think they're down to like 15 days of diesel left, so that's what I'm talking about is like, are we facing a cliff where these refined products, because boats take a couple of weeks to get out, and we're going to have this gap of boats that, hits Southeast Asia, that hits Europe, eventually will hit North America too. So jet fuel is like jump the gun, but I'm just saying, like, is it basically like where's the danger point? Is that 2 weeks from now, 3 weeks from now, where we're just going to have like a global, like, right now it's kind of a crisis, but I mean like a real crisis where there's just like not actually like what you heard about, like you guys know because you're old enough, but I wasn't alive in 73 where like there was no fuel basically.
Right. And that's something, that's what we talked about a couple of weeks ago, that you can have the oil flowing, but if you don't have the refinery capacity to put the oil through to make the product, that's a bigger issue. And that's what's played out. That's been the bigger issue. Part of Saudi's refining capacity was taken out by some bombings that occurred a couple of weeks ago. So that is, you're spot on. That is the critical issue. And where are we? I think, it starts, as far as a crisis, starts to creep in, as you pointed out, beginning in Europe in probably a couple of weeks. And, again, this has to settle down quickly to start to repair or get some of this refining capacity back online, which is not going to happen fast. And we're we don't have any spare capacity in the U.S. for all practical purposes for refining.
You know what
Yeah.
I've been trying to think through, and I touched on it with Bob last time we were on together. You know, if there, I wrote a piece this weekend called "Boots on the Ground" because I think that's the next step. And if it comes to that, I suspect Iran will pursue a scorched earth strategy. So I've been trying to anticipate. I haven't pulled the trigger, but I've been trying to anticipate. You know, what's the next play, and it's going to be some kind of reconstruction effort, whether it's, you know, in Gaza, whether it's in Iran, whether it's in the Ukraine. I don't know, but so I've been trying to think through, you know, how do you play that reconstruction effort? You know, Fluor, Jacobs Energy, you know, Caterpillar, you know, GE Vernova. You know, there are different ways of playing it depending on whether you're playing, you know, the energy grid or the, you know, you can play with you know, Schlumberger. But I don't know, Bob, have you thought through the sort of the ripple effect of boots on the ground type of?
No, and that's the right way of thinking about it. Those are the right names. You know, we've taken a position in Schlumberger. You know, we've been building a position in Baker Hughes, Halliburton, the ones you mentioned, all the construction companies that would take part in the rebuilding of facilities, whether it's the LNG facilities, whether in Qatar, or whether it's drilling wells in Iran, if they do take that scorched earth strategy, and somehow at some point, U.S. is able to get back in there and have a regime that's willing to cooperate and go back and start drilling wells again. But that's pretty far out there. I don't know how and when that might occur if there were this sort of scorched earth strategy, whether it's on their part or the U.S.'s part in what Trump's threatened to just blow up their oil wells in Carg Island and everything. That would be, and again, he doesn't want high oil prices. So it's sort of a, you know, tricky strategy. And the longer this war goes on, the less support it has. You know, right now, Spain is not allowing the U.S. to fly their airplanes over the country because they said it's an illegal war. You know, support on, you know, in the U.S. poll wise with midterms coming up is sort of waning a little bit here if this thing continues to drag on. If you put boots on the ground, that's really, you know, opening up like with Iraq and Afghanistan, where lives are going to be lost. I mean, you've got, you know, it's guerrilla warfare and drones, and you put boots on the ground, you're putting a lot of U.S. and other troops in harm's way. That's really, really difficult if that's the tactic you have to take, if they're not willing to cooperate and open things up themselves, allow the U.S. and Israel to come in and inspect or take out the uranium or do whatever they have to do. And I think that's why it's, you know, despite what Trump continues to say that he really thinks there's going to be a deal, that they're really far along in negotiations, it's really hard to imagine that, seeing what that is, what that looks like, and that it's really, really regime change in the sense of things are different. It's just hard to imagine what that entails, but we'll see.
Yeah, well, you know, it is one thing that has definitely shown people that energy is the primary money. I think people sometimes take that for granted. And, you know, I have this slide in the presentation I give on macroeconomics to the grad students that shows the arbitrage that one barrel of oil is about $200,000 to $500,000 of human work, depending on how much you want to pay them and what you think their output is. But like, that's a good arbitrage, and we've all been living off that for a while. But, you know, just going to 100 starts to squeeze people. All right, Charlie, let's. And
the one thing I want to point out, Ben, we're not buying or selling anything. I'm sticking with the names, especially on the E&P side. You know, I'm not writing covered calls, not selling anything, but not chasing anything, just sticking with the positions we have here. And, you know, sort of watching these, as Charlie pointed out, if there's incremental money to be put to work, it's going to be in the service or construction names. But for the most part, we're just sitting here and holding tight.
Yep. And so let's go, Charlie. You know, what are you feeling about the market right here? We can talk about financials and rates in a second, but like, how are you feeling, you know, just in general on risk as we go into, you know, it's end of the quarter. So I kind of personally expected, you know, I covered a few things on Friday just because there was no bid. So maybe today it's a little greenish. It's not like ripping or anything, maybe tomorrow, but like, it's been a rough month, and it's a rough end of the quarter. Like, what are you feeling as we go into April?
I'm still very bearish. I'm holding on to a lot of my short and put positions. I think there's another leg down here, probably associated with boots on the ground. The trading today and tomorrow is probably being motivated by the London whale. That's that big, huge, collar, and the gravitational pull is towards 64.75 so on the S&P. But I think once we get past March 31st, there's going to be more downside. So I don't see any reason to chase this market today.
Yeah.
But I one of the names I wanted to talk about, if I may, Ben, is Citigroup, because on Friday it was very weak. It was down 4% on Friday, and it was weak because there was a Bloomberg story saying that Citi was going to go out and buy a regional bank, and that caused some consternation that they're going to reallocate their capital away from buybacks towards acquisitions. And people want buybacks because the stock's trading around book value, so it's a very good return investment. But my conclusion is that Citi is going to buy a regional bank. By the way, Citi did come out and say that the Bloomberg article was baseless speculation. Those were their words.
But they have to say that, right?
Yeah, they do. They do. Yeah. Because they don't want their stock to get hit by all sorts of uncertainty about what are they going to do next on the acquisition front. But I honestly think they should, and I emphasize should, buy a regional bank. I just don't think they're going to do it this calendar year in 2026. And let me tell you why they should. First of all, Citi needs to shore up its core deposit base. They don't have a strong retail consumer deposit base because they don't have a branch network here in the United States. So they need to do that to add stability to their funding profile. So that's number one. Number two, if they do build out this retail deposit base, it's a natural cross-sale opportunity for the private bank wealth management operation that they're also building out under Andy Sieg. And that has revived. Citi's really good, with the high net worth individuals in Asia and internationally, but they've got a mediocre, private wealth operation here in the United States. And so this buying a regional bank would give them that opportunity to cross sell. And then thirdly, they're in the process of divesting Banamex, the Mexican consumer operation. They've sold 49% of it, already. And they'll probably, by the end of this year, will have sold all of it. So they're going to lose about $1 billion of net income. So they need to replace that net income. Now, obviously, selling that improves their capital and allows them to buy back stock. But they want to replace that net income that they lose. And so buying a regional bank would help them replace that net income. And then final, and I think this is the part that people really don't understand and is very important. Citi has about 29.5 billion of deferred tax assets, what we call DTAs. And those deferred tax assets have a limited life, about 20 years. And they haven't been able to use up those DTAs very rapidly. I think last year they only used up 0.7 billion. So they need to figure out a way to generate more net income to use up those DTAs. And by using up DTAs, you literally turbocharge your regulatory capital. So for every dollar of net income that you generate, you can, using your DTAs, you can generate $1.50 of regulatory capital. So I think buying a regional bank makes a lot of sense in the effort to use up those DTAs and turbocharge regulatory capital. So I think they will do a regional bank acquisition. I don't think they're going to do it this year because they're still focused on their transformation efforts and the divestiture of their international consumer banks. That will be completely done by the end of this year, put them in a very clean position to then now expand. So I think 27, 28, they're going to do a regional bank acquisition. The article in Bloomberg highlighted PNC and Truist as potential takeover candidates. I doubt those two would be where Citi would start because they're each over $500 billion. Citi's what, $2.5 billion. So they represent about 20% of Citi's balance sheet. That's probably too big a chunk to start with. So I think they're going to go lower into that 150 billion to 250 billion asset range. And the two names that come up on my screen are Citizens Financial out of Providence, Rhode Island, and Regions Financial out of Alabama. They have good core deposit consumer bases. They have a strong and developing private banking operations, and they have a decent capital markets activities that would be additive to what Citi already does at the large level. This would add a middle market level capital markets capability. So those two I actually modeled over the weekend. I think Citi could pay 30% premium to market, and it would actually be mid-single digits accretive to earnings. Accretive, not dilutive, accretive. And I don't think anyone who has done the work who's thought about this has done the work yet to understand that this would be additive to earnings and generate capital. So I like the idea that they should buy regional bank, and if the stock is selling off as it did on Friday because of that fear, I would be buying it hand over fist. So my plug for buying Citi here on any weakness.
Okay. You've been pretty good on Citi, Charlie. That thing was a dog forever, and you yeah. I think around the time I met you when we started Wall Street Beats, you were coming out, and I know you said it earlier, even more like back in the SVB year. So great call. No reason to stop listening to you now. I mean, but in general, how you feeling about banks though? I mean, financials. I know
I don't see any reason to step up and aggressively buy banks here. I think there's another leg down. So this was just a special case because of the news item on Friday. I just wanted to try and paint a picture 2 years out what could happen. And Citi I'd buy under 100. I've been fairly consistent recently saying I think it's going lower, but I'm a buyer under 100.
What would you pair against it if you were going to say, hey, I like Citi as an idiosyncratic trade. I don't really like banks, which is kind of what I'm hearing from you. What would you short against it?
Goldman Sachs. They have tried to convince the street that they've generated this stream of annuity revenues from their financing, basically their prime brokerage business, which is financing this bubble in the markets. And so they're developing huge counterparty risk. And Ben, you sent me a table over the weekend showing this huge rise in for the purchase or carry of securities. And it literally just goes parabolic. I don't know if you have access to that, Ben, to put it up on the screen, but and that is epitomizing what's going on. The prime brokerage business and the financing of the players that are creating this asset bubble is being done by the Goldman Sachs of the world. And they're generating this huge financing revenues as a result of it. And if there's any kind of unwind of the carry trade or deleveraging of the system, all of those revenues are going to go away. And yet people view them as annuity revenues. And I think it's just as cyclical as anything else that Goldman, is in. And it adds a counterparty risk. Now, Goldman's usually pretty good about managing risk, so I don't want to say they're going to blow up. But I think there are other Archegoses out there. And Goldman is, because they're financing them, is very vulnerable to that type of situation.
Yeah, I don't have that chart, but I do remember seeing that, and I was like, "What the hell is this?" It was outrageous. It was a hockey stick, and I think that's something that Charlie, because you're a bank analyst and you write research on it. But the NDFI and the securities financing spike of the last, let's call it 18 months, has been outrageous. And now it might be abating, and I don't know if everyone just appreciates how much that flew into the GDP numbers and, to more importantly, the stock market, right? And that goes away. That's $1.5 trillion of headwind of incremental that came out. So I don't know. That's 2% of GDP or something like that.
Yeah, we talked about that on Friday, but so I
5% of GDP. Sorry,
won't repeat myself. But there's a really good article in the Journal today. I just wanted to mention on how these PE private credit firms and private equity firms are understating the amount of software company exposure that's in their loan portfolios. And it comes back to how you define a problem determines what you think your exposure is. And I cut my teeth following the Texas banks in the early 80s. And I learned a hard lesson. So in 1982, 83, 84, the Texas banks were saying our exposure to the energy industry was 12%. But it was based on a very narrow definition of what energy was. It was literally the miners or the oil companies. But as the crisis grew, you realized it's the local cat dealer that was, leasing equipment to the miners that also was, going to be affected by a downturn in energy. So by 1987, 86, 87, when all these Texas banks were failing, their exposure as redefined was 30 or 40% to the energy industry because they were including all these ancillary plays. And so, one of the things that my colleague Lily Collins wrote about is how the software industry, as defined today, excludes healthcare, for example. And yet there's a lot of software companies in the healthcare industry. And so the Ares and the Blackstones are truly understating their software exposure if you start to think beyond the GIC, the GIC, the definition of software. So I think we're going to find out that these companies have much bigger exposure to problem, industries.
Okay.
And Charlie, how does that exposure get revealed? I mean, if these are private equity investments, what is the event or catalyst to reveal this overexposure that causes some ripple in the market? At the fund level, I think again, my colleague Lily Collins has done a really good job of digging into the individual names at the fund level. And she has pointed out, the tremendous overlap. And I think that's what the Journal did. The Journal did their own investigative reporting. It's a really good article if you have a chance to read it. It did their own investigative reporting, and they found out that these companies were defining things strictly along the lines of GIC, and yet there were other loans that they considered as software related. So, but you have to go into the actual fund document level, which takes a lot of time and digging. So kudos to the Journal for that article, by the way.
All right. Yeah, it's interesting. Pretty tame out there today. Although, I will say on Friday, and I talked about this yesterday. Friday was the first day. Charlie and I talked about on Friday privately. It was the first day the hedges started work. The Staples and the Utes did well, and my SOFRs did well. Rates stopped getting absolutely hammered. Gold traded up a little bit. And even today, we got oil up 2%, but stocks are, modestly green. And so,
December SOFR is up 9 ticks this morning. I mentioned that on Friday as a buy.
This December 26 or 27?
26, because they had taken everything out of the 26. There was no cut.
Yeah, no. The 26 was. I was actually thinking about buying that. I was like, you know what? Look, it's if I hadn't gotten so hammered on the Z7s like in March, it's just you're a little gun shy when you take as big a L as I did in March. Although I think I'll get my money back. I mean, but the Z6s and H7s, Charlie, how did I tell you or what? Did I tell you Z7s are better than Z6s?
you had the call, Ben. I absolutely agree. Right.
Well, the call would have been get the hell out of there. That would have been the right call. But I mean, I guess what I'm saying is maybe you just got to think about it's the end of the quarter. Like that was a painful month for most people. And it was the kind of pain that's the worst because, well, bond guys got absolutely destroyed. Gold got smoked. But for stocks, with the exception of Bob and energy investors, it was slow, right? It was like 50 bips, 80 bips, 100 bips. We had maybe 2 days that were 1.5% or 2% days. And you know what happens then? your puts don't really work that well, you know? And so hedging was just really, unless you were in energy, didn't work last month. And that's kind of the worst case scenario for people. So let's keep an eye on that, you know. And again, I don't like putting anything too much on the end of the quarter, because that, you know, Wall Street is very notorious for window dressing stuff. Right? You guys been in the game longer than me, right? Like, that's not a controversial statement.
Yeah.
No, and I wouldn't underestimate the impact that the London whale collar is having right here.
Yeah, all that, 100%. I'm just saying that, you know, Friday there was no bid. It wasn't panic selling, but the hedges were starting to work. That was my takeaway from Friday. But the equity market and credit were selling just steadily, not anything panic. Then today we're getting, you know, whatever, and oil's not down, you know, oil's up. And so I think you just keep an eye on it. I don't think there was really anything incremental that happened over the weekend. So, you know, it didn't mean the risk had to sell, especially after such an ugly Friday. But I think that, like, after Tuesday, I think we'll see the game gets go back. And let's remember last year, Liberation Day got going on April 2nd, right? You had a little break there. You had a little break from, you know, sometime in March till kind of the end of March. And then the game got going real quick on April 2nd. And I'm not saying it's going to be that. It's because it's a different situation. But, you know, there's some liquidity issues into tax day historically, right? Yeah. Yep. So stay vigilant and come check us out. We're talking about it. We got stocks. We find stocks to buy as well. Like Charlie's pitching you Citigroup, even though he doesn't like banks. You know, that's good stuff. All right, guys. I think that's it for today. I am Benjamin Bry. That's Charlie Peabody. Bob Morris at Wall Street Beats. Come check us out tomorrow. Thanks.
Great. Thanks, Ben.